Hello and welcome to our quarterly update and outlook. My name is Ed Newton with Newton Wealth Management. We put these videos together to help you as you continue along the path to achieve and maintain a worry-free retirement. Before we get into the update, you need to know that Newton Wealth Management is responsible for the content of this video and reflects the current opinion of the speakers. It is based upon sources and data believed to be accurate and reliable. Opinions and forward-looking statements expressed are subject to change without notice. The securities are offered through Archer Investment Corporation. This information does not constitute a solicitation or an offer to buy or sell any security. A risk of loss is involved with investments in stock markets. The commentary provided should not be regarded as personal investment advice, and past performance is no guarantee of future results. You should carefully consider investment actions in light of your goals, objectives, cash flow needs, and time horizons. I feel like we're living Charles Dickens' book, A Tale of Two Cities, only in reverse. With apologies to Mr. Dickens, it was the worst of times, it was the best of times. The first quarter of 2020 turned out to be the worst of times. Even though we started the year on a very positive note, the pandemic quickly thrust us into the worst recession since the Great Depression. There's no need for me to recap the events for you. You lived them. I do believe that it is worth highlighting a couple of market-related developments and what we might learn from them. As investors, it is important for us to acknowledge that markets anticipate developments that few foresee. On February 19th, the S&P 500 index closed at an all-time high. The next day, stocks were down just 0.2%, just typically a daily blip, one that we rarely remember. We knew about COVID-19, but it was mostly isolated in Asia and seemed to be rare. There seemed to be no rational reason to treat it any differently than SARS in 2003 or the swine flu in 2009. As politicians acted over the next month to contain the pandemic, stocks quickly digested lockdowns and the economic consequences of them. We hit bear market territory, which is defined as 20% down from the prior high, just 29 days later, the quickest ever. Just 11 days later, we closed down 34% from the high. But the next day, stocks rose. They continued to rise, overall and on average, for the next several weeks, even though record-awful economic data began emerging. TV pundits and commentators said rising stocks were ignoring reality, but now, looking dispassionately at the movement of the stocks, we see that they had simply shifted to looking further into the future. Past the immediate hemorrhaging, past the gradual fall in COVID caseloads, past the baby steps that politicians were taking to reopen the economies here at home as well as across the globe. They looked to a day further out when we all learned how to live with the virus and maintain some semblance of normal economic activity. As the second quarter progressed, more and more cities reopened that eventually became more apparent. By the end of June, those that hung on were rewarded with global stocks increasing 38.2% off the low. Now don't let anyone tell you that it was easy. Staying the course, remaining invested, continuing to believe in your investment plan took all the human patience one could muster. As you can see from this chart, we had the fastest bear market in history. We also had the quickest decline to being down 30%, as it only took 18 days to do so, while it took 55 days for both the October 1987 elevator drop and the 1929 stock market crash, and well over 300 days for the market to decline by 30% for the 2008 financial crisis and the 2001 dot-com bubble. It was also the quickest as it lasted only 29 days. The average bear market lasts nearly 300 days. This year's rocky first half is no doubt one for the record books. If you endured all the swings, worries, uncertainties, and painful drops, congratulations. The rebound since March 23rd is part of the reward for your fortitude. Let's turn our attention to the outlook for the rest of this year and into 2021. I think the first thing to illustrate is that no matter how bad a bear market has been, the subsequent bull market lasts longer and increases value significantly more. We talk about bull markets and bear markets, and I want to be sure you know the parameters for each. A bull market is defined as the period of time from the lowest close reached after the market has fallen 20% or more and lasts until the next market high. Conversely, a bear market is when the index closes at least 20% down from its previous high close and continues until it reaches its lowest close afterwards. Here's a chart of the bull and the bear market since 1926. Looking at this chart, it is quite apparent that bull markets outrun and outpace bear markets. As you can see on the chart, the average bull market lasted 9.1 years with an average cumulative total return of 480%, while the average bear market period lasted only 1.4 years with an average cumulative decline of 41%. Let's chat briefly about the current economic climate. June's employment report indicated that non-farm payrolls increased by 4.8 million, topping the consensus estimate of 3.23 million, according to the Bureau of Economic Analysis. While a full recovery remains a long way off, there should be no doubt at this point that a recovery has commenced. Keep in mind, however, even some of the largest companies in the S&P 500 index are taking steps to preserve capital. As of June 30th, a total of 41 companies in the index had suspended their dividend payouts, and another 21 had cut their dividend distributions. There's still a good deal of uncertainty surrounding the potential fallout from the COVID-19 pandemic, including its duration. The economic recovery has begun. The worst economic quarter in post-World War II era is behind us, and the question now shifts to how quickly we recover. We hope this information has been useful to you. Our goal at Newton Wealth Management is to help clients achieve and maintain a worry-free retirement. We are a fee-only firm. That means we don't receive commissions or any other compensation from the investments that we utilize. We have a fiduciary responsibility to our clients, which means that we always put your interests first. If you haven't set a plan or not sure that your plan is appropriate for your goals, we would be happy to talk with you and see if there's anything we can do in order to get you on track so that you too can achieve and maintain a worry-free retirement. If you have $250,000 or more of investable assets, I would invite you to visit our website at www.newtonwealthmanagement.com. There you can find out more about our firm and the services we offer. Again, the website is www.newtonwealthmanagement.com. From the website, you can also contact us to request a no-obligation, no-fee consultation. We look forward to hearing from you at www.newtonwealthmanagement.com. Newton Wealth Management is responsible for the content of this podcast and reflects the current opinion of the speakers. It is based upon sources and data believed to be accurate and reliable. Opinions and forward-looking statements expressed are subject to change without notice. Securities offered through Archer Investment Corporation. This information does not constitute a solicitation or an offer to buy or sell any security. A risk of loss is involved with investments in stock markets. The commentary provided should not be regarded as personal investment advice. Past performance is no guarantee of future results. You should carefully consider investment actions in light of your goals, objectives, cash flow needs, and time horizon.